Good morning. Hey, everybody. Grab your cup of coffee. Join me for morning coffee. I've got a special guest today, Aaron Grinhaus, all the way from Toronto, Canada. Aaron, it's good to see you this morning.
Thank you very much, Mitch. It's great to be here.
Well, I'm excited to have you here because we are a show each morning that talks about AI, Web3, the metaverse, all the business and tax issues that are associated with that. And I can't think of anybody more qualified to join us on this morning's show to help give us some guidance when dealing with all the different crazy tax issues that come up when we're dealing with cryptocurrency, when we're dealing with Web3, when we're dealing in the metaverse. And that's exactly what Aaron was kind enough to agree to do for this morning's show. So what I'd like everyone to do is, while you're grabbing your coffee, while you're joining us, while you're waking up at 7 a.m. on the West Coast, 10 a.m. on the East Coast, share this out. Ask your questions in the comments, and we'll bring your questions in, and we will make sure that everyone across Facebook, LinkedIn, X, Instagram, and YouTube are part of today's show. So let's do this, Aaron. I want to give you a proper introduction, set the stage so that everyone has context about who I have as my guest today. Aaron is a trailblazing business and tax lawyer who's shaping the future of Web3, advising on everything from offshore tax structures to cutting-edge blockchain technology. In addition to being an adjunct professor at Osgoode Hall Law School, which is one of the top law schools in Canada, he's also the author of the world's first legal textbook, A Practical Guide to Smart Contracts and Blockchain Law in Canada. In 2022, do you have it over there, Aaron?
Actually, we just published the third edition in January, which is rebranded to A Practical Guide to Web3, Blockchain, and Smart Contract Law here because we covered so many more since that first edition.
That's amazing. And that's something that, the more you learn about this stuff, the better off you're going to be. So I can't wait to get...
There are US editions and international editions now as well.
And I'll share them in the show links when we're done with the show. That's amazing. Thanks, Aaron. Here's something else that's dear to my heart. In 2022, Aaron's firm, Grinhaus Law, became the first Canadian law firm with an office in the metaverse. And he was one of only a few law firms to have a venue in the metaverse at that time. He's also the founding member of the Metaverse Bar Association, where I happen to serve as an advisor. That's where Aaron and I met. And once again, let me give a coffee hat tip to our dear friend and mutual friend, Madeline Zanis, who's the co-founder of the Metaverse Bar Association. She introduced the two of us, and we've been rocking and rolling in the metaverse ever since. So, Aaron, it's really good to see you, to bring your expertise to the show. I think the biggest challenge that I've seen when it comes to creators and builders, entrepreneurs, business owners, playing in these new digital sandboxes, and there are many, but the primary issue I see is those that are using cryptocurrency to do transactions, to buy, to sell. Can you tell us a little bit about, from a tax perspective, what happens every time you use crypto to buy an item, to sell an item, to accept payment for something, whether it's in the metaverse or in real life, and what happens when you use Bitcoin to roll over or buy ETH, or ETH for another type of coin or product? What are some of the tax things that you think our community should be aware of?
Yeah, so that's kind of a hard question to answer in one sentence. And the reason is because, there are a lot of different, the problem with tax rules is they're so complicated, and they create so many different rules and sub rules for different transactions and different things, that it really depends. I know this is such a lawyer answer, it depends, right? But it depends what you're using it for, how you're using it, and how you've been holding it. So, for example, if you bought some Bitcoin in 2015 and then you sold it in 2024, and you didn't do anything with it in the interim, it would likely be characterized as a capital gain, as capital asset. And a capital gain, as you know, is, as you may or may not know, is treated and taxed preferentially compared with current or business income or income from employment, which you just apply your marginal rate to that, whatever it is, and that's the amount of tax you pay. So in certain jurisdictions, capital gains are completely tax-free. In the United States, the capital gains rate go up to about 20%. And in Canada, they're between 20 and 40% now. They just increased them. So that's still better than the top marginal income tax rates, which in Canada are 54%. And in the United States are significantly lower, and around the world they can be zero or at other rates. In Europe it varies. So in terms of decide, like the first step is to try and decide, is this a capital gain? Am I just buying and holding, or maybe I did one or two trades throughout the year, but generally I have a full-time job doing something else? Or is crypto really should be considered like we're doing it in the course of business, so it's inventory, and when it's treated as inventory, you don't get that capital gains treatment from it. So that's kind of step number one. Now another question I got, actually just put an article on our website about this yesterday, it just published it. This question I just keep getting is it possible that stable coins get taxed in some way? And it turns out yeah, you can. And the reason is, in Canada anyway, and in a few other jurisdictions.
Can you explain what a stable coin is?
Oh, stable coins are coins that are linked in value to a specific thing. So the USDC, US dollar coin, doesn't fluctuate in value the way that Ethereum or Bitcoin does with the markets. Okay. It will always be worth $1 US. So the question is, how can you realize a gain or a disposition with a stable coin? And the answer is, if you buy Bitcoin at $100, let's say, and then you sell it for $500, but you don't sell it for fiat currency or cash. Instead, you trade it into USDC because you want to freeze the value. You think, wow, it's probably going to drop in a couple of days, so I want to freeze this value. When you did that, there was a capital gain of $400 because you bought it for $100, and even though you've traded it in for stable coins, that $400 difference between what it was worth when you bought it and what it was worth the day you traded into stable coins, you have to declare that as income. You have to declare that as a capital gain. So it's not really a tax on stable coins, but it's taxed the same way whether using trading between stable coins and other what they call security tokens. Sometimes they call them that. Sometimes they call them things like utility tokens and things like that. But those aren't really tax terms, right? The only issue here is whether it went up or down in value. So if you have a utility token, one that was created for a specific purpose, but it's traded on secondary markets and it's going up and down in value, just because it has utility doesn't mean that it won't be taxed when you sell it. Okay, so the exception to that might be NFTs, though, because NFTs are treated more like commodities, right? So even though it's not a security, it won't be necessarily considered a security. But again, if you bought the NFT at a certain price and you sold it at a certain price, then the gain would have to be declared. You have to declare that on your income.
So a couple of questions have already come in, Aaron, and I purposefully did not become a tax attorney because for two reasons. Number one, I'm not smart enough, and number two, I had an interest someplace else. True story.
Yeah, says the very highly accomplished litigator.
Anyway, well, you and I both know that's a whole different arena. But what I was getting at is there's a whole conversation to have about taxing digital currency, how to properly file, how to create different entities in different parts of the world to minimize your tax exposure, maximize your net income, build out businesses that you can pass on from one generation to another. And I listened to you on some of your other YouTube videos about some strategies to do that. And we're not going to go down that rabbit hole today, but I wanted to plant the seed for our audience that there's some really advanced well-established methods to minimize taxes and maximize everything that Aaron's talking about. And if you connect with Aaron, he'll turn you on to the videos that I'm talking about. It's impressive, it's complicated, it's something that you want him to do, but I also thought it opened up my eyes as to what we're talking about. And just backing back down to or rising back up to the 30,000 foot level, Aaron, what I'm hearing is when you go to Coinbase or another platform and you click and buy or sell Bitcoin, you click or buy or transfer Bitcoin for ETH, every single instance there is a potential taxable event that needs to be taken into consideration. I think there's a lot of creators and builders out there that aren't paying attention to that one little detail. Am I right about that? And if so, what should they be paying attention to?
Yeah. Well, okay. So one thing I forgot to preface this whole thing at the beginning is nothing I'm saying is legal advice. Every situation is very fact specific. All of this information is very general. And one of the things that I'll say to your point is tax is not only very fact specific, because one person making a certain amount of income from one thing will pay different tax and have a different situation, have different options than their spouse or even their best friend or anybody else, like every situation. And then on top of that, every jurisdiction has its own rules. And
thank you.
One of the things to really note is tax is one of those things that is so closely guarded by countries. It's almost like a mark of sovereignty. Like they do not want to give up any of their authority with respect to tax, because without it, they can't function. It's their lifeblood. In fact, the tax authorities are usually the most powerful agencies in the country. In Canada, they can take your records, they can lock down your bank accounts, they can put you and your accountant in jail, and then ask you, before they even go to court and get a proper court order or have you come to a hearing. Like there are so many different things like compliance orders that they have here that are terrifying. So you want to make sure that you're doing everything above board, and you don't want to tick off the tax authority in whichever country you're in. So when it comes to trading, the same things apply, right? In Canada, when you're trading they were trying to figure this out. What happens if you buy a can of Coke with Bitcoin? How are we going to treat that? And really what they did, rather than exploring a more technical and advanced method of divining what type of tax and how much you should pay, they went back to the earliest rules you could possibly imagine that you could probably even find in the Bible, the barter rules, when the first chicken was traded for a goat. That's how we treat them here. That's where we look at what is the value of the can of Coke, what is the value of the crypto, and if you're trading it in the course of business, you have to declare that as income, whatever the value of the other thing was when you're trading. When you're talking about doing it on an exchange, typically buying for cash, there's no taxable event there. So that's pretty much across the board. If you're just buying Bitcoin for cash, that doesn't create a taxable. It's when you sell it for cash or when you sell it for other digital assets that you have to start calculating how much was your gain when you bought it. And if there was a gain, there's usually tax to be paid. And if there wasn't, then there wasn't. And then you might, even if you're doing it in the course of business, you might even have a deduction to carry forward in future years, which capital gains often can be carried forward quite a long time. So if you realize a gain in the future, you can offset that against the loss that you had one year. So just to close that loop, though, if you're trading, like I just said before, between different cryptos in certain jurisdictions, you have to see what the difference is from the time you bought it to the time that you traded it into ETH or a stable coin or something like that. And that's the gain that you have to declare. So buying, typically, if you're buying for cash, there's nothing really to declare. You just need to keep track of how much you bought it for and on what date. And then in the future, if you end up trading it into another crypto, or if you end up selling it and realizing a gain, that's where you have to pay some tax.
I want to reiterate that no legal advice is being given. We're simply having a conversation. No financial, no investment advice is being given. It's just a pleasure, Aaron, to have you on the show. And I hope what we're doing is just kind of reminding everybody, especially new business owners and creators and builders that are just getting into the space and playing around with digital assets and artifacts, that there may be and probably is some type of tax ramification to what they're doing each and every day, and they need to pay attention to it. They need to consult with an expert to stay ahead of the game and hopefully to plan accordingly. If you plan properly, and that's one thing I've noticed with my successful business clients over the years, Aaron, and sure you can double down on this, is those that plan ahead when it comes to tax issues, tax ramifications, tax planning, business succession planning, are the ones that usually are doing much better than everyone else. Okay, it's a game. It's a very objective game oftentimes. And I heard you mentioning that. It's like, these are the facts of your case. These are the tax laws. These are the countries you're in. This is the type of transaction. These are your three options. Talk to your accountant about what these three options are, and then Aaron's firm helps you design and put everything together along with the help of an experienced accountant or accounting agency. But I want to pivot just a little bit, because we can still talk about digital currency, but I also want to talk about the metaverse. And
Can I just say one quick note about
absolutely
planning? Just
absolutely.
One quick note about planning. It's
you
true.
Jump in anytime.
Planning is important, but remember, every year there's a budget that amends the tax codes. So in the United States, it's being wrestled right now in Congress. They're trying to figure it out. In Canada, every year, in fact, in Canada, it's a confidence motion. So if the budget doesn't pass in Canada, there's an election. And that's rare, but it happens. It has happened. So while you can plan, what's that saying? Man plans and God laughs. Have you heard of that one?
Well, what I have heard, Aaron, is prior to the 6 Ps I learned at my first year of law school. Prior preparation prevents piss poor performance. Kind of the same thing.
Yeah. So we plan for the worst and we hope for the best. By planning, I don't want to say conservatively, but practically and pragmatically. So there's a couple more Ps for your list. Practical and pragmatic. We want to try and anticipate what's going to happen while buttressing what you've already got, and then moving. And then when it comes to tax planning, by the way, there's 3 real big pillars on tax planning. One is tax income splitting. So if you can split up, the principle is 2 people making $50,000 a year pay less tax than 1 person making $100,000 a year, because the graduated tax systems we have. And so if you can income split by taking money into a low tax entity like a corporation and then dividending it out to many individuals or using a family trust structure, that's one. Income tax deferral. So if you retain earnings in a lower tax entity like a corporation for a period of time and then take out what you need to live rather than taking it all out at once, normally corporations will have a lower rate of tax. And then tax rate minimization. And that's where you're trying to find a jurisdiction or a structure that gives you the lowest rate of tax. So certain jurisdictions, and not everyone's eligible for this, by the way, they've closed a lot of the loopholes, but we still have options. And I encourage people, to reach out if you see significant gains coming down the pipeline in some way, shape, or form. A lot of Ripple people are reaching out to me, XRP, because they see, something big happening there. And so we've started helping people structure in anticipation of that. But yeah, you can plan. You can try to plan, but those are the 3 main things that we look at when we're trying to plan.
So, Aaron, what I'd like to do in the last 10 minutes of our conversation is let's answer this question if you're able to, and then I want to bounce over into the metaverse, which also has to do with international borderless tax planning that I think a lot of people are interested in. So for those of you listening and not watching, a question's been asked by Alicia Butani. The question is, are there any drawbacks of Canada intending to apply the International Crypto Asset Reporting Framework, I guess it's called CARF, C-A-R-F, for taxation by 2026? If so, what are they? Is that a question you're interested in answering?
Well, hello, Alicia. Nice to hear from you again. Can you repeat the question, please?
Are there any drawbacks of Canada intending to apply the International Crypto Asset Reporting Framework for taxation by 2026?
Look, the framework is, thank you for the question. The framework is designed to help countries, to help different nations establish a more uniform way of dealing with the issues. Like I said, tax is very jurisdiction specific, and they guard that very jealously. And so it's been difficult in many ways. The OECD, for example, the OECD nations have been trying to create frameworks to for a more uniform guidance for tax authorities, for anti-money laundering authorities, and for securities authorities among different jurisdictions to try and coordinate. So when they do that, it can be good or it can be bad. And it can be good because it makes things more efficient. It makes things more uniform, and it helps people understand it better. So you're not spending a ton of money trying to figure out what to do next when everybody's agreed on how it should be done, especially when you're dealing with a number of jurisdictions. But it can be bad in another way, because it'll now create other obligations that are foreign to you, no pun intended, that are now imposed on you, that your advisors and you personally have to now grapple with and you have to deal with. So I guess we kind of have to see how these things play out. There is a lot of talk and a lot of fronts on how different standards are going to be adopted on this, and a lot of it's been settled. And in Europe, the MiCA regulations just helped settle a lot of the issues around how digital assets are treated. And so it is helpful, and it does allow for more clarity for advisors. And like I said, we want certainty, but the rules are constantly changing. And without that certainty, we don't really know how best to serve our clients. So having a uniform framework is certainly a beneficial thing to have for guiding professionals and their clients on how they're going to plan going forward.
I would suggest that everyone with questions reach out to grinhauslaw.ca. The link's on the screen. Connect with Aaron on LinkedIn to start that conversation. I'm sure he or a team member will be able to get you going in the right direction. I want to pivot over into the metaverse in the last couple of minutes, because this is where we met. This is something that's dear to each of our hearts. I think we will see a tremendous upside in technology, especially with AI complementing everything that we've been working on for the last couple of years. And talk to us a little bit, Aaron, about the Metaverse Bar Association, about your interest in the metaverse, why you started your firm in the metaverse a couple of years ago, and also incorporate for our listeners, our business owners, our creators, our artists, what are 2 or 3 things they need to pay attention to when doing business transactions in the metaverse? It might relate to tax implications, but what are the biggest mistakes you see happening? And moving forward, what should they pay attention to?
Well, I'll tell you, one of the biggest mistakes that people make, and it's very prevalent, is relying on social media for legal and accounting advice. Okay, so that was kind of the impetus for the Metaverse Bar Association. I'll explain why. So when we got together, we realized that there were a lot of people out there calling themselves blockchain lawyers or blockchain accountants or metaverse lawyers and things like that. I've been in the space for a long time. I started out early on investing in Bitcoin and ETH, and I started doing a lot of projects in Canada. I was one of the first, not the first, but one of the first lawyers in Canada who was representing people on ICOs, Bitcoin mining operations, BTM operations, crypto investment funds, just structuring high net worth individuals. And so that's how I kind of fell into writing the textbook. I actually published the textbook because I got so many questions from other professionals. It was designed to be a practical guide for them, and that's what it does. And then, shortly after that, I became the co-director of the Osgood Web3 program. And then, so on the personal side, on the academic side, and on the practical side, I've done it all, and I've seen it all done. And when I started seeing the kind of advice that people were giving and getting from first from X or Twitter, and from Meta, Facebook, people had groups on there. There were listservs and other chat groups. And I was looking at this and I was thinking, okay, this is ridiculous, because you could be getting advice from some kid in Singapore, some 16-year-old kid on his computer in Singapore who knows nothing about this stuff, but he's got some really popular blog and he's giving out all this stuff. So the first reason we created the Metaverse Bar Association, which by the way is metba.io, so metba.io, was to create and legitimize a group of professionals, lawyers and accountants primarily, who actually they know this stuff. So we can, if you go on that website, you can find a professional that we've vetted, that we found out that they are actually who they say they are, and they have the credentials, and it's on there. So that was number one, is to try and legitimize. And by the way, we're going to be, I suggest you sign up for the mailing list, because we have just entered into an agreement. It's very exciting. We're going to be announcing it soon, where we're rebranding and everything, and there's a new website and everything's going up. So we just grew so quickly within a year that we had to do our Mitch knows about this. So legitimizing the space, that was number one. Just make sure people know that who they're asking is actually going to give them real advice, and they're qualified to give that advice. The second thing was to create continuing legal education continuing professional education, or CPD, professional development, around this stuff for all the people. And if you're a member, you get discounts on that. And if you're not, you could join in and watch it anyway and learn about things like this, like tax, except they go and do a little bit more deep dive. And then the third thing is for networking, and that's how Mitch and I met. I think it was very successful in that regard, because you get to connect with people who are like-minded and who can share thoughts and ideas. Some people are thought leaders, and then we have people who've developed regional groups in their home jurisdictions. They organize meetups in person. We're going to have conference soon coming up. We're just planning another surprise that I just gave away by accident. Ooh. But that's okay. That's something to keep an eye out for. So this is really exciting, because in most bar associations, they're specific jurisdictions, but there's no jurisdiction here for the metaverse. It's borderless. It truly is a technology that's borderless. And so what we're trying to do is break down the last set of borders, which are the legal ones, by allowing us to share and collaborate and understand, just like an international tax. It's very complicated. I do a lot of it. It's very complicated, but there are treaties. There are agreements, there are rules that are all laid out, and there are tons and tons of rules. But if you it's like turning a Rubik's Cube. The way I just describe it is, you keep turning that Rubik's Cube until you get a side, and then you keep turning it until you get the other side, and you just have to keep turning and turning and turning until you find the right combination to get you to where you need to be. And so that's the fun part, actually. That's the problem solving part. So that's the I guess the point of the METBA, and the point of why we set it up and what it's for. So I hope you all take a look at it and you join it if you can.
Absolutely. For me, Aaron, the fun part is introducing a lawyer to the metaverse for the first time, and showing him, her, or they how they can interact in a new way with a client across the street or on the other side of the world, in their pajama bottoms or as an avatar, and have almost a much more meaningful conversation. It's a very intimate setting if you handle it correctly. It's just a whole new way of practicing law, or at least offering your services. And I just love that part about being in the metaverse. When I keynoted in Toronto, a year and a half ago, and I think I was going to meet Madeline there, but we didn't. I had taken a paddleboard to the center of my head, and my forehead was like this. I looked terrible, right? And when I took the stage, I just broke the ice. Look, you can either look like this in real life, and then I pointed over my shoulder to one of my avatars standing in the metaverse like this that looked like $1 million, or you can look like this. This is one of the many advantages that the metaverse has to offer. And immediately everybody laughed, and they got it. This is a whole new opportunity to communicate and connect. But with that opportunity also comes new business challenges, contracts, licenses, tax implications. What are the taxable venues or jurisdictions? If I'm in California, you're in Canada, we do a business transaction, what are the tax issues associated with this? It gets to be kind of complicated. And maybe in the last couple of minutes, just give our viewers something to think about from a business side of thing. If you're doing business in the metaverse, pay attention to the following 2 or 3 issues. Speak to a professional about them. What are those 2 or 3 issues, Aaron?
Yeah, I mean, one of the things you want to identify at the outset are the jurisdictions of all the players. So first, figure out who the individuals, and not just individuals and corporations. So any entities, like people are considered entities and corporations. So figure out the jurisdiction where those people are. That's number one. Okay, you have to establish that. And then you should establish the residency of those individuals, human individuals as well, because typically corporations are deemed to be resident in the jurisdiction in which they are incorporated. But an individual can be a citizen of one country and a resident for tax reasons of another country. So you have to identify not just where the people are, but what their tax residency is and their citizenship. And then you should also consider who the controlling minds are of the entities themselves, because there are different rules in different jurisdictions about how the corporations will be taxed depending on where the individuals are, or how the individuals will be taxed. Like in the US, the global intangible low tax income rules, the GILTI. It's kind of a fun acronym, GILTI, right? GILTI.
I heard you mention that last night.
Yeah. And the central management control rules in Canada and in the UK. So there are other, there are all these things that determine where is the control, not just where is it. So you could be incorporated on the moon, but Canada might still have jurisdiction to tax that corporation. And then determining the type of business activity, because different types of business activity and what types of taxes will apply to that business activity. Determining the economic substance of the business. So where is the business located? Where is it actually located? So if you have a company where everybody's doing business in Canada, they've got a factory in Canada, they've got factories in the United States, and they have people in the UK, but they've incorporated in Cayman, they might not meet the economic substance tests because there's nothing going on in Cayman. These are new tests, by the way, that were just recently implemented in the islands. And then if there's intellectual property, you have to take a look at how that's being conveyed to different and used in different jurisdictions. So these are the main things, like where are the people, where are the businesses, where is the management and control? And if you're using intellectual property, how and where is it situate, and who are the people using it? So if you have it owned by one jurisdiction as being licensed to another jurisdiction, that won't likely meet the economic substance test. Like you have to figure that out. So those are kind of the top things. And then in terms of tax reduction, just keep all your expenses and deductions ready, because those are going to be, when you're creating a structure like this, are going to be a lot. And so it's good to speak to someone like me first, to have a quick consultation to plan how you're going to do it, like a 1 hour, here's what we need to do. You get all the facts, make sure it fits to what you're doing. And then kind of where you need to go. So speaking to somebody who's really well apprised of these issues is important.
Well, and I've got that individual with us right now, live, all the way from Toronto, Canada. Aaron, this has been fantastic. It's, we've been talking about using terms of service agreements. We're going to wrap this up, everyone. Terms of service agreements to help delineate, to help identify, to help determine some of the things that you just mentioned between the parties that could be contracted away, right? Not everything can. State and federal laws sometimes will supersede what two private individuals or companies may just try to do. But I think when you blend everything that Aaron just mentioned in with properly using TOS agreements, and then Aaron, once you create this wealth within your company, you set up a proper tax strategy, you're using TOS agreements, guess what? In today's Web3 and Metaverse worlds, we still have data privacy and security issues. Like there are new liabilities for all of us doing business. And I want everyone to minimize their exposure to making bad privacy decisions, bad data security decisions in what you're doing in business, so that everything else that Aaron talked about today can be preserved, not only for the benefit of your company and your family, but for your heirs too. And we're going to talk about that next Wednesday during our Web3 Wednesday. We're going to be talking about how creators and artists can help minimize privacy issues, maximize data security issues when doing business on a daily basis. And we'll be going live at 7 next Wednesday. So that should be fun. Aaron, this has been fantastic. I've got greenhouselaw.ca posted at the bottom of our screen. Really appreciate your time. I know you're extremely busy, and I'm looking forward to seeing you again in one of our metaverse spaces. But between now and then, if anyone would like to reach out to you, if anyone has any questions, what works best for you?
Yeah, just send me an email. That's the best way to get in touch. It's just Aaron@grinhauselaw.ca, Aaron. And you can go to the website and take a look at what we've been up to. There's a lot of informative blogs on there under the Knowledge Center, but please feel free to reach out by email. I'm happy to discuss.
Fantastic. Aaron, thanks so much for being here. Thanks everyone for joining us both live and recorded. And until next time, my name is Mitch Jackson. Enjoy this crazy upside down AI Web3 Metaverse tax journey that we're all on, and never stop making each day your masterpiece. Bye-bye, everybody. Thanks, Aaron.
Thank you.